Hello everyone, welcome back to the Quiet Trader series. I'm Trace by Ibra and this is episode 7 in this playlist too. Now with this episode, we are going to see how to connect narrative bias liquidity to the level of execution. Okay. Now with that said, here we're having how to read narrative. Now the first point I want us to understand is that narrative drives us to bias. You can't have bias if you don't have narrative. So we are going to also see or talk about liquidity then to the execution, but the main reason for this video is narrative, okay, because we talked about liquidity in the previous episodes. Okay, now what do we mean by narrative? I know that could be the question you're having in your mind. Let us break it down. The narrative is simply the story of the market for that day or for that week. Okay, if you're in a day, you're gonna try to build a narrative from the daily. Okay, you're gonna build a story on what the market is showing you according to the time frame Jolico. Okay, you're gonna answer questions like, are we likely expanding higher or lower? Like when you look on the marketplace, when you look on the candles, because candles tell us, it is information told through candles that we see on charts. When you look on the chart, we're gonna talk about Olava. Are we likely expanding higher or lower? Like when you look on the candle, you're trying to build a story. Most times we want to build a story, kubange flowing, right? Kubange ifanagana. Okay. Are we in redistribution, accumulation, or rebalancing an imbalance? Okay. You're seeing that or you're finding that on a chart through the candles. Who is trapped, buyers or sellers? Where might price run before the real move? Because that's gonna give us a higher probability that what we are anticipating for price to do is really underway. Okay. Now, narrative comes from higher time frame structure. You're gonna build narrative on a higher time frame. You can't build narrative on a lower time frame. Okay, that's where I build narrative. And we also build narrative from liquidity and PD arrays that are available on the charts. Like when you look on the chart, because charts zina information yetusoma, information on how the structure jeberimu. Now you understand that after you doing backtesting and seeing how the market uses these PD arrays and the levels. Okay, you can't just come out of the blue and start to be seeing things you can't understand, because reading charts is like you going back and studying the language, because the market is communicating to us through candles. Okay, it's telling us, it's hitting to us what's gonna do next through candles. So it's like a language, Josoma. Okay, when you have a narrative, you stop reacting emotionally, because now you understand the language, you understand the story as to why price is gonna do what it's gonna do. We are gonna say that. You start thinking, okay, this makes sense. This story makes sense. Okay, but you're gonna wait for the confirmation for it to make more sense to you, so that you can take an entry from the narrative job buildings, from that story job buildings, from that plot. Is the market supporting the narrative you're having? That drives you to what? To pass. Okay, let us talk more about narrative. That's like narrative is about understanding the market's story as to why price is gonna do what it's gonna do. Why do you think price is gonna take that liquidity first before moving to the anticipated direction you aiming for? Golowooza lwaki price yandiyagadde okutekinga that, because those may be the trapped buyers, and price is gonna want to take that liquidity, then it's gonna aim for the opposite direction. But why do you think the market is gonna show you that? You don't just use patterns or see patterns and just follow them. Narrative helps us to anticipate likely price movements. We predict the future and position ourselves strategically. We don't just out of the blue say that the market is gonna move to the upside, or we react. We don't react according to the market's movement, but we wait and we get confirmation on what we have been predicting or anticipating to see. Predictive framework. It is a logical framework for anticipating where price should go next, involving identifying whose liquidity, in bracket stop losses, because that's why the market moves. have been taken and who might be next. For example, buy side may be taken out, then what do you think is going to be next? If it's not going to be a continuation to the upside, obvious safe side is going to be next, then you're going to look for an obvious old low or obvious relative lows, and that's going to be your target. You wait for the confirmation the market is going to move into that direction. It's beyond technical, like it's beyond technical analysis. Mostly for the indicators show what's happening, like what's happening or what happened. Most of the indicators show that, but with narrative you're gonna see what happened, and you're gonna tell what's gonna happen in the next candles. Okay, you're gonna know where and why. Price is often revealing to us the market is underway logic. So we're going to understand that this is where the market is going to go next with the narrative. We are going to know why should price go to that level. Why should it take that liquidity before going to your level? Why should it be? Why do you anticipate it being reactive onto this level? It could be in premium, and you anticipate for the market to be bearish. Okay. Contextual understanding. It helps us to understand or move beyond simple patterns. Those are like the bull flag, bear flag, something like that. But we understand the market with institutional order flow, not just flow, but institutional order flow, as we talked about that in episode 5. Now, that also helps us to identify the rhythm and the reason behind the price delivery. Okay, that is when we move with institutional order flow. Now, with this last point, we use narrative to establish bias. If you have bias, you already have if you have narrative, you already have bias. You're gonna decide whether to buy or to sell, and those are the opportunities you're gonna be looking for. Okay, so the bias is gonna be bullish or bearish. Simple. When you already have narrative. Okay. So for the idea of building bias, when you already have narrative, already in a bias. Okay. When you understand the storyline, the plot of the market, already in a bias, because tosobola kubanga in a bearish narrative of story yokuba market egenda kuba bearish ate noba ne bullish bias. No. Okay, just to go through bias. Bias is not, I think it's going up because you feel like it's going up. No, it's not a feeling. It's not emotional. Bias is a logical expectation or anticipation based on structure. Liquidity after understanding narrative. So you must understand narrative and understand structure through the lens of institutional order flow. Then you will have a good bias. Okay. So just to go through this, it is formed on a higher time frame. That's gonna be daily. When I go or when I'm doing my top analysis for a new month, I start from monthly. For a new week, I start from weekly. For a new day, I start from daily. Okay, that's how I do my top down from daily to the lower time frame, and that's how I build my narrative on high time frame to the lower time frame. Okay, you're gonna look onto the structure. Is it bullish or bearish? Okay, now you check if price is in discount, which favors buying, or premium, which favors selling. Okay, then you're gonna ask yourself just the question is building a narrative. Have we run stops recently? All of that, you're building narrative, and that is gonna take you to bias. Okay, on daily time frame, any PDRA hit or sweep of old highs and lows. Okay, you're looking on the marketplace. You're looking through a lens of institutional order flow of its structure. You're building narrative. You're building a plot as where price should go next if it is here. Okay, are you approaching any major levels? We might be approaching any PDRA, and that could bring us or give us a break in structure for us to the opposite direction. Oh, it's gonna be just a continuation. Okay, and that, or it could still be a target for us to target, and we see if it's gonna just continue a GTM yesi over again a reversing la AO. Okay, then with that idea of building narrative, your mindset becoming that if this is the narrative that I'm having from the higher time frame, for example, you wanna be the narrative a kubulira like story when you listen to your story, the market is showing that it's gonna be bearish. Okay, you stick in that higher time frame narrative, then you're ignoring all the bearish setups. You're looking for the bullish bias or setups occurs matching up with the bias. Okay, and if the market clearly invalidates your bias, you flip with no ego. Okay, now this is when you're into the marketplace and your bias is wrong. Okay, because we are gonna have those errors, we are gonna have wrong biases. Like you switch without no ego, you switch with confirmation, with rules. You don't just flip because you were wrong and now you want to be doing revenge trading. No, you switch bias if the market has proven you or has shown you that your bias is wrong, that it is invalidated. Anyways, okay, now liquidity, we took that in the episode of liquidity and PDRAs. Yes, we are gonna go through it first in here. Okay, the market, we all know, moves for one main reason: to collect liquidity. Liquidity sits where? Okay, equal highs, equal lows, previous day high, previous day low, session highs, session lows, swing highs, swing lows, trend line touches. Everyone can see. We saw that in that video. That was episode 6. Before making the real move, price often runs for those stops. If you're gonna be bearish, price will run for an old high or relative equal highs or into any PDRA that is in premium, grabs those orders, then shifts the direction into the direction you're anticipating on the narrative. So we don't need to chase that run to the stops. Okay, for example, price pushes above yesterday's high, and that could be relative equal highs, session highs, any high. Okay, everyone is gonna buy the breakout, is gonna chase that. Okay, that run, you're gonna see that on a chart. So when it breaks out, then it reverses. For us who understand narrative on a higher time frame, we are not gonna chase that manipulation. It is just a hunt for liquidity. Okay, for us, our job is to wait, not to predict every spike. Okay, we wait and we see that yes, in our narrative, buy side has been taken. We have been having that in our narrative. Okay, now we are gonna wait for the price to give us a structure shift into the direction we anticipate to see after stripping that liquidity or those stops. Okay, we prepare for the execution. Okay, now turning the narrative or the storyline into an execution is where discipline matters most. Okay, to take the narrative, it is a story, or you're building a story from high time frame. If market is here, it's gonna do this, it's gonna do this. Okay, why do you think it's gonna do that? You're building all that. Okay, now here's the sequence. Liquidity is gonna be taken, stops swept above or below a key level. Market structure shifts. You see the first sign that momentum flipped after getting a run of liquidity and a swing low. For example, when you are bearish, when there we get a market structure shift. Okay, then price returns to your entry level. Entry levels, like it could be a fair value gap, it could be a breaker, so it could be an order block, or for example a 50 to a 62 level Fibonacci levels. And for example, if we are bearish, we want to be above. Okay, price should come to a premium level. If we are gonna be bearish, price should come below the 50% level to the 62% level of a Fibonacci level, and that could be for the buy side, like for the buy program if you anticipate to be bullish. Okay, we have also other PDRAs, but for now let us talk on to those ones. So you execute according to the rules zoberoina. So you have a defined stop loss even before finding the position jobero geno kubango entering. So you already know partial take profits levels wizidi wogeno kubango taking a partials. You already know that even before going into any positions. Okay, you're not gonna do any over leveraging, like you're not gonna be overconfident, like for you to put in more lot sizes. So not chasing the candles, you're gonna wait for the confirmation that the market is gonna move into the direction that you anticipate. Now price is so running and taking out that old high. It's not that any old high taken you're gonna be selling. So you must wait for the confirmation. You're not chasing the candles. And your entry must agree with your buyers and the liquidity story, the narrative. Okay. If they don't line up, you skip the trade, and that is where you learn how to know. Like that's where you learn not to take every trade. Okay. So let's have an example in here. Let us say on higher time frame, you're having a bullish bias. Okay, you have built your narrative and you concluded with a bias and a bearish. Okay, price opens, rallies above yesterday's high. Okay, and that is liquidity taken. Okay, then we see a shift bearishly. You spot a shift in structure. Okay, price retraces into a premium. Okay, it's where we want to find our entries if we are bearish. Then our target is the opposite zone, and that is the discount, and those could be session lows and imbalance below. Okay, I want us to go to a chart and we see that on a chart. Okay, so when I hide this, let's first look onto this. What do we have in here? This is a swing high, right? Because the high yellow candle, this is a little bit higher than that candle. Like high yellow candle, a little bit higher than this candle. Okay, now the same with this candle, swing low. That's the dealing range. In this dealing range, Twinam PD arrays chi. Twinam volume imbalance 1, a daily, because this is Nasdaq 100, a daily time frame. Okay, Twinam volume imbalance 1 in. So when price traded or dropped, created this range, when it started to move back into where? To a premium, because if this is a high and this is low, this is discount, this is premium, it went back to where? To premium. Okay, because you know price runs from discount to premium. Of what range? Of this dealing range. Okay, not this one. The same with this one. Low, high, came back to where? To discount, back to where? To premium. But let us focus on this dealing range in here. Okay, price went back to a premium array, and that is a volume imbalance. That one there. It created a swing high again. Now it has created another dealing range. We shall talk about more about dealing ranges. Also having some video you get dealing ranges. Now this is a swing low and this is a swing high. When a swing high is created, we have got a dealing range. Anticipate price to come where? Back to a discount from premium, because this is premium of this another dealing range, and this is premium of this dealing range, where it hit a premium array, and that's the volume imbalance of this daily, came back to discount. Okay, let me unhide so that we have more understanding. Okay, I want us to see after hitting this daily volume imbalance in here, price started to drop lower back into a discount. Okay, let us have a fib to remove the doubts. So when price started to drop, we have this suspension block. We have this volume imbalance in here, and this volume imbalance in here, and this gap in here. On a weekly, it is a volume imbalance. That is the yellow box Jola. But this is a suspension block. It is a real imbalance. Okay, so when price created this swing high, started to drop, this is our target. This all green box is our target. Okay, so for more clarity with this dealing range, with Tuna hitting a midpoint, we can still anticipate price to move lower because of between this volume imbalance also in here. So that could still be our target. Okay, so when price opened in here, because this is a down close candle, it closed from there, and this is a down close candle also, it opened from there, it gapped, it closed and gapped from here, opened from here, Then we roll this. This is what we're gonna see on a lower time frame. Back into this daily inversion fair value gap. Now, why did I choose this daily inversion fair value gap and I didn't use a fair value gap in here? Because we have a fair value gap in here. Now, most times, like to me, I like to use arrays as a better opposite after a return. And in my anticipation, we are gonna be bearish because these arrays is much stronger than this. Now, when you look, most times they are aligned as a term. But I will stick to the high and the low of these candles. I won't adjust it to this low. I want to stick to this. Like to me, this feels more stronger than this one. But still, no, still you may get the same results. Okay. But when you're gonna see as to why I could like to use the array ebere, still the same thing. If you're bullish, still you're gonna use arrays as ebera ku mukono gweno. For example, like it doesn't only work when the market is gonna be bearish, you know. Okay, we're gonna see as to why I could want to use that. Okay, this array is very opposite. It's very much stronger because if price runs through it again, we don't want to see price closing above that. If it was already disrespected, price should respect it, then the upper part of it if you're gonna be bearish. Okay, now this is Friday's trading, and I want us to go to the 1 minute chart and we see what happened onto that time, like onto that time frame. Which are happening is for us to get that lower price or that down close candle. Okay, so here's the 1 minute time frame. I want to zoom in here. Now when you look, this is the 9:30 opening with the first presented fair value gap. The fair value gap we get after 9:30 opening, that is the first presented fair value gap. We want to have that. Okay, now price traded through that. This is all manipulation, a lot of manipulation in here, but we wait for what? For our silver bullet. That's where we want to find our entries. We are not focusing onto this. We don't care. We are just watching. Mostly we want to see this if we are bullish. Sorry, if we are bearish. If you want to see price to drop, you want to see that run on what? This is a swing high. That is buy side liquidity. Old high in London swept. Okay, that is buy side liquidity to a what? To a PD array, that is a inversion fair value gap on a daily fair value gap. Okay, and that is in premium. We want to see discount prices, like we want to see price moving to the lower after getting that. We said in previous slides that price often runs to the opposite direction or likes to sweep stops, like it wanna grab those orders. Okay, cheri mukora right here to a PD array on a higher time frame. That is the inversion fair value gap. More inversion fair value gap to inam fair value gap. Okay, and that is the CB. Now when you look close onto this, okay, before heading there, let us zoom in here. Look onto this, how the encroachment of this inversion fair value gap was respected there. At what time? In the macro, the 950 to the 1010. That is a macro. That's why you got this fair value gap in here. Okay, that fair value gap in here. Now when you look onto this, from this high to that low, premium is above the upper half of this fair value gap, but me taking a trade just onto the high of that candle, like it's not that much perfect, but it is okay, because if I put my limit order, if I wait for price to just trade above that high, my stop is not that much, 45 points, aiming for something like 100 points. You think that's, I think that's not bad. Okay, because if you may want to aim for the premium, which must be done. Okay, but you already have a defined stop loss. Okay, we are not here to be perfect. Okay, now because you may to me, my stop loss, the high I can go is 60 points. Okay, with the account Janina, the high I can go is 60 points. But if my stop loss is not even 50, like I can have a trade within here. Okay, that is my worst entry. My worst entry. Price came to the premium or the upper half of that fair value gap, which was a good selling opportunity. Okay, so my worst entry could be on that high. My worst entry, worst, because of a defined. I already defined my stop loss. That if price comes to this worst entry, my stop loss is already defined. Okay. Now, that's not breaking a rule. Okay, because the stop loss is defined. Okay, stop loss yange sigenda kuenteringa position nga stop loss yange eri egenda kubeera eno waggulu because I feel like price won't come to my entry. No, because I already defined my stop loss. The high I can go is 60 points. Anything below 60 points, and I can really be into this fair value gap. It's okay. Okay, to me it's okay. So buy side was taken, old high, a swing high has been taken out. That's data soup to the upside. Swing low, market structure shift, and the fair value gap. You wanna sell that. Perfect entry, a good entry. Like using the word perfect is like that doesn't sound good when in trading, but that could be really perfect entry in here. Premium stop loss just there. That couldn't even take more than 40 points. So that's how we build narrative from high time frame, not chasing the fake runs, not chasing the hunt of these old highs, of these old highs. Okay, now someone, if you're gonna be bullish, now this is off topic, but how are you gonna be bullish? Okay, how are you gonna be bullish? Because I don't think you're gonna buy this fair value gap. This is what? This is in premium. Okay, so there isn't anything for you to be bullish. If you had, like for example, off topic, but for example, to gamble but daily bullish. Now, where is the setup already bullish? Tell you, that means you're gonna wait. The more you wait, the market is dropping. That means you're not gonna get any entry for you to be bullish. That means you're served. Okay, so you don't need to chase, and it's okay for you to be anticipating a bullish bias, but within the entry gyonoonya, teriwo wano. So you're not gonna find it here. Okay, you're not gonna find it here. So you're gonna sigala with your bias, but the entry egena kuba togifunye. So that means you're not gonna take any position and you're not losing any money of that. Okay, you're losing nothing of that because the setup where the market is really moving to the downside. At all, I'm breaking this low. You're not gonna be wanting to take any other position to be long. You're gonna wait. You're gonna wait to where? For example, if you anticipate to be bullish, when you look onto this, I'll call this smooth little criminals in here. Those lows, okay? Relative equal lows that they were dumped and swept within here. Okay, now between us in old highs. When you look onto this, it's a swing high. Liquidity has been taken. Those smooth old lows, swing high, which is the market structure shift. Price tried to come back, stretched into that fair value gap in here. Stretched. Now this also has a defined stop loss. Okay, just below there, like 24 points there. This was really quick, like it like tier dumping and you are trading and into that fair value gap, but that could be really a good entry for you to import these old highs. Okay, so when you stick to the narrative and bias and wait for the confirmation that the market is gonna move into that direction, you're really gonna get what you want. If the bias is wrong and you still look for the entry is supporting your narrative or bias, tezigenda kubanga mweziri if you're offside. Like in such, tewali anything that supports this price to move to the upside. This is premium. You don't want to buy that. You want to see if price is going to come to there. And when you buy from there, you're going to have a defined stop loss. For example, you buy, something below. But that's offside. This move, the Chirimono move, it's not there. You don't want to be bullish. This, no. Okay. So let us go back into the charts in here. Okay. On the slide, sorry. So something like to notice. You didn't chase. You waited for that liquidity to be taken out. You waited for that buy side, that previous day high to be taken out, and that liquidity to be taken out. Okay. Then price traded into that premium area, which was a daily inversion favorable gap that we saw, and then we executed when everything lined up with the narrative that the market is going to move to the discount. When it created the other first swing high, toward the reversal. Okay, then we anticipate the price is going to trade into the discount of that second dealing range here toward them. Okay, that is trading with intention. You know why price is doing what it's doing, and you're anticipating the next candle. Okay, when we are wrapping this up, these are going to be the key reminders for you. No narrative, no trade. Bias should be logical, not emotional. You're not having emotional feelings that the market is going to move to the upside, or when you see market running as the way you saw it when it created that first present favor lookup, it ran to those old high, to that premium area on a daily time frame. You're not gonna be impulsive of that and the market, and you chase that. No. Liquidity usually gets taken before the real move. We saw that liquidity was taken. What was the liquidity? The old highs, the previous day high, then to that PD array in premium of that daily dealing range. Execution requires patience, rules. The goal isn't to win every trade. The goal is to only take trades that make sense. Okay, that's gonna be it for this video. Hopefully it has really been impactful to you on the way you see the markets, the narrative, on how to build the story when you see or when you look on the charts. Stay disciplined, and I will see you in the next video.